Did you know 85% of the US companies with more than $100 million of revenue, those big names shaping the markets and our economy, are private? Hi, I'm Rich Powers. In this video, we'll explore the three biggest shifts transforming private markets, how capital formation has changed, whether private equity returns are still worth the risk, and what the rise of semi-liquid funds means for your clients' portfolios. Well, companies are staying private for longer, and there are a range of reasons for this. Access to a large and growing pool of capital, ability to minimize regulatory and disclosure requirements, and the opportunity to take a longer term view of value creation by company management rather than focusing on quarterly or yearly targets are among the most meaningful drivers. Now, what data highlights the significant growth of the private markets? The following stats have made the story come alive for me. First, the total private markets universe, which includes private equity, private credit, infrastructure, and real estate, has expanded from $800 billion in size to $16 trillion over the last 25 years. Private equity represents the majority of that figure, growing from $600 billion in size in 2000 to more than $10 trillion in 2025. And just shy of 10% of the global equity market cap is held in private equity companies. Finally, 85% of companies with revenue of over $100 million are private. Strong returns that private equity delivered leading up to the early 2020s were driven by an environment of relatively attractive company valuations, lower interest rates, and a value creation playbook that supported stronger company returns. Since then, interest rates have risen, as have valuations, creating near-term headwinds for private equity. Nevertheless, private equity can play an important role in long-term portfolios, but outcomes vary widely and depend heavily on manager selection. For example, the difference in 10-year internal rates of return for the 5th percentile and 95th percentile PE manager is over 5,000 basis points. In contrast, the difference in return for top and bottom US large cap public company fund returns was about 1,000 basis points. This highlights the importance of manager selection in private markets and the significant differences in the skill of quality private equity managers in deal sourcing, operational execution, and realization. Using our forecast, how could the inclusion of private equity in an investor portfolio impact outcomes, assuming access to a quality PE manager? Well, let's start with a base of traditional 70% stock and 30% bond portfolio of public investments. The median 10-year return rises from 5.3% in the all public portfolio to 6.2% when private equity represents 30% of the equity allocation. Risk increases, but not proportionally to returns. Portfolio volatility rises from 10.1% to 11.5%, reflecting the higher standalone volatility of private equity. So what's the key advisor takeaway? When integrated thoughtfully, private equity can increase the likelihood of achieving long-term goals while adding to portfolio diversification. First of all, expanded access to private equity is a positive development, as advisors can now more easily allocate capital to a market segment that has historically been restricted to institutions and very high net worth investors. Semi-liquid or evergreen structures broaden participation, and these vehicles are becoming more common in advisor portfolios. These vehicles generally offer improved tax reporting and improved investor onboarding experience, and periodic liquidity relative to traditional partnership or drawdown funds. On the liquidity feature, which for most evergreen funds provides the chance for investors to redeem on a quarterly or semi-annual basis, it is important for advisors to remember that liquidity is periodic and conditional, because after all, the underlying assets remain long-term and illiquid. Investors allocating to these structures should be long-term too. And just like public equity market investing or PE investing in the traditional drawdown structure, manager skill is critical. Digging into the depth, quality, and stability of the investment team, understanding their investment edge and portfolio construction approach, assessing their capabilities and meeting the unique liquidity needs of evergreen funds, and of course, the all-in cost of the fund should be prioritized during due diligence. To put it all together, the decision to allocate to PE interval funds should reflect client liquidity needs, time horizon, risk tolerance, the cost of the investment, and the advisor's ability to access and oversee high-quality managers. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.